Ladies and gentlemen, good day and welcome to the Gokaldas Exports Limited Q3 FY23 earnings conference call. As a reminder, all participant lines will be in the listen-only mode. There will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Binay Sarda from Ernst & Young. Thank you, and over to you, sir.
Thank you, Dovin. Good afternoon to all participants on this call. Before we proceed to the call, make a forward-looking statement that may involve known or unknown risks, uncertainties, and other factors. It must be viewed.
Sorry to interrupt, sir. The line for you is breaking up in between at the moment, sir.
Am I audible?
No, sir, it's still breaking up in between.
Am I audible now?
Yes, you're audible, sir.
Thank you, Dovin. Good afternoon to all the participants on this call. Before we proceed to the call, let me remind you that the discussion may contain forward-looking statements that may involve known or unknown risks, uncertainties, and other factors. It must be viewed in conjunction with our business risks that could cause future result, performance, or achievement to differ significantly from what is expressed or implied by such forward-looking statements. Please note that we have mailed the results and the presentation, and the same are available on the company's website. In case if you have not received the same, you can write to us and we'll be happy to send the same over to you. To take us through the results and answer your questions today, we have the top management of Gokaldas Exports Limited, represented by Mr. Siva Ramakrishnan Ganapati, Vice Chairman and Managing Director, and Mr. Satyanmurthy, Chief Financial Officer. We'll start the call with a brief overview of the quarter gone past, and then we'll conduct the Q&A session. With that said, I'll now hand over the call to Mr. Siva. Over to you, sir.
Good afternoon, everyone. Happy to have you at our earnings call for the third quarter of FY23. We continue our exceptional trajectory, delivering performance with strength and resilience when the industry is encountering a challenging global macroeconomic environment. We reported a revenue of rupees 528 crores, almost at the same levels of previous year. In contrast, the Indian apparel exports declined in the third quarter by 3.1%. Currently, major consuming markets are passing through uncertain times, and there are signs of a global economic slowdown as macroeconomic factors and declining consumer confidence seem to undermine the past gains. Having said that, amidst these, we continue to stay focused on operational excellence and customer service, as these are cornerstones of our growth levers. During the quarter, as volume growth remained flat, we strongly focused on improving employee and operational productivity, balanced our orders on hand with capacities well, and reduced operating expenses. We delivered a superior EBITDA margin of 13.1% after adjusting for one-off income of 3.3 crores. We continue to manage our working capital well and generated adequate free cash flow to support our growth ambition. While the US retail and e-commerce market so far has shown resilience and have performed well in FY22, we anticipate a mild slowdown in the offtake going forward. This is already reflecting in our Q3 revenue. On a sequential basis, our revenue has been falling from Q1 to Q3. We expect this to have bottomed out and will see the trend reversing starting Q4. We have done well in a downturn, and this is no exception. We intend taking market share during such times and ride the growth curve in the aftermath of the downturn to deliver strong growth. We view the long-term macroeconomic factors are favorable for the growth of the business. In the short term, we are closely watching the macroeconomic environment for any developments that may be adverse to the business and further strengthen relations with the customers and ensure execution excellence and service delivery. With this in mind, we continue to explore avenues for growth. We are progressing well with our CAPEX plan. The unit in Madhya Pradesh is expected to commence commercial production in first quarter of FY24, and our NITS project in Tamil Nadu too is progressing well, setting the stage for a strong future. Further, we may explore other avenues of growth as well, including opportunities to invest in good assets that may fit in with the overall strategy of the company. Our growth trajectory for this financial year is intact, while we continue to build a firm foundation for strong growth in the years ahead. I thank you for listening and would be happy to address questions that you may have.
Thank you very much. We will now begin with the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Mohit Khanna from Banyan Capital Advisors LLP. Please go ahead.
Hello, sir, and congratulations on the execution in a seemingly difficult macro environment. My question is related to the fourth quarter that you might have some visibility, because the year over year, the last quarter, the base was very strong for you. And you have just said that we should witness some quarter-on-quarter improvement here on. So coming with that in mind, you had previously guided 2,200 crores of revenue for FY23. Do you think you might still be able to beat that? That would be our first question, and I'll come back.
So the answer is absolutely yes.
Okay.
We're very confident of doing that, and definitely we'll do that. Oh, you're talking of 2,200, right?
Yes.
Yeah, definitely.
Okay. And then how do you see FY24 panning out? Is a 15 to 20% growth over 23 is a good number to work with?
So the way as I said earlier, we've had sequential declines from Q1 onwards, right? So Q2 over Q1 and Q3 over Q2. I think we are more or less hitting the bottom, and now we will start, the curve, sequentially will start turning. So as we go forward, I am expecting that H1 of next year sequentially will be slightly better than H2 of this year, and H2 of next year we are hoping that will show a further growth. That's how I'm looking at it. So overall, I think we will get back into the growth trajectory on a sequential basis.
Understood. And in terms of margin, because this quarter has also been very strong, the other income has actually improved for us from 2 crores in a quarter to 9 crores in this quarter. What exactly is the reason for that, and do we see the similar trend going forward?
It has two components. One is on account of the interest income from the investments, whatever we carry, interest income and mutual fund income. The other one is about 3.3 crores. We got one-off income, which we have highlighted, some of them on the legal issues, which we got the settlement, which has been recognized, and another some provision which was not required has been reversed. These are the two, which is about 3.3 crores one-off income. But otherwise, the rest is on account of the interest income arising, or interest income and income arising on account of the mutual fund investment.
Fair enough, sir. I'll get back in the queue. Thank you so much.
Thank you.
Thank you. Participants who wish to ask a question may press star and 1 at this time. The next question is from the line of Abhineet Anand from Emkay Global Financial Services. Please go ahead.
Yeah, thanks for the opportunity. First, I got slightly confused. You said sequentially you should see better numbers in Q4. While commentary from US retail, you have been saying that it has been resilient till now, but you expect a mild slowdown in the offtake in expected short term. I think those two probably doesn't match. So am I getting something wrong here?
No, that's not, So what happens is the end user market influences the brands in turn to place orders on us. So the brands have been anticipating a slowdown already and had, tapered down their buying even earlier. That's the reason why the brands have been buying a bit slow in Q2 and Q1. Now, so whatever happens in end user market, the brands have to now plan 2 quarters ahead. So if we are seeing a slight uptick, then it just indicates that 2 quarters ahead, the brands may be seeing that the volumes may slightly pick up.
Okay. Thanks for the clarification. Second is that, in terms of knits, what kind of margin versus the woven that we presently have, what could be the differential or how is it different?
So the knits is a processing unit. So processing unit, so there is a garment processing, the fabric processing unit, and then we will of course have some downstream garment manufacturing also. So overall, while the capex investment, since we are putting a processing unit, the EBITDA margin in knits may be about 6% higher, but then as its contribution to overall revenue will, to proportionately only it will contribute. You understand?
Yeah, I got it. I mean, let's assume what is the investment at the knits factory and what is the asset turn in that?
Little over 100 odd crores. It's about 120 crores.
And the asset turns are different from a woven factory?
Yeah, it's about 3.5.
Okay. And last one, for now that the MP, commercial operation expected in 1Q FY24, what type of incremental, revenue can we expect or utilization can we expect there in F24?
So in F24, MP will be expanding, or it will start progressing. So there are two parts to it. One is the manpower ramp up will start. So a lot of people currently, we have hired, they are undergoing training. This is almost a 45-day training cycle. And then slowly they will be inducted into trial production, commercial production, etc. So the manpower growth will happen through the year, and their productivity will also start growing with a phase lag. So if you ask me, what is the expected revenue from MP in FY24, I believe it will be about 55 to 60 crores or thereabouts.
Okay. So that is the only incremental revenue apart from some modernization, etc., that we might do in our existing units, right?
No, so we will also have, that's not the only capex we are looking at. So we will also be looking at, as things start, opening up, we will also have other capacities come up. We may also do some brownfield capacity unlocking. So there are other avenues to grow as well.
Okay, sir. Thanks a lot.
Sure.
Thank you. The next question is from the line of Sunil Kothari from Unique Asset Management. Please go ahead.
Thanks for opportunity, sir, and congratulations for such a remarkable, very respectable numbers during this very challenging time.
Thank you.
Sir, my question first is on this. Now we are reaching quarterly interest cost of around 9-10 crore. By when you feel we should be coming back to maybe the of 4-5 crore per quarter? Because I think now interest rate is also going up and our debt is also, I think, has increased.
No, the interest has got two components. One is on account of Ind AS and the other one is the regular interest. If you look at it, the Ind AS interest contributes 4 crores during this quarter Q3. So our real interest is only about 40 lakhs. Rest is on account of bank charges close to about 1.3 crores. So totally the interest is less than 6 crores, of which real interest and bank charges, if you look at it, it will almost around 1.7 or 1.8 crores.
So this is some exceptional. We should take as a 9 months number, whatever given. That is the run rate we should expect, or you feel any major change in interest cost next year?
In the 9 months interest rates also our interest cost is close to 7 crores. That is about 1.7 crores. 1.4 crores is the interest. About 5.5 crores is on account of bank charges. Rest of the amount almost around the balance 11 crores on account of Ind AS interest.
Mm-hmm.
So the real interest, the finance charges is for 9 months is only 7 crores, of which interest cost alone is around 1.4 crores.
So, sir, my basically I wanted to understand is annual interest cost which you will be debiting to P&L.
Yeah.
What we should count? That is what my question is.
Going forward, our
finance cost, I mean.
There are two components. One is real interest cost plus finance charges is not more than 10 crores on a yearly run rate. Interest cost is around 15 crores.
Okay. So roughly 25 crores should be the cost of finance annual around.
Correct.
Correct. And sir, my broad question is, somebody has also tried to clarify this. Your confidence of growth seems to be coming from what? Basically, it's a expansion of products, customer, market share. If you can little elaborate and if you can speak more about, say, next 2-3 years, how you see the opportunity after this, maybe some 3-6 months slowdown or whatever slack.
Sure. So the way I see it is that, the end user market in the US in particular has been by and large resilient. Even the February numbers seem to indicate that the market is somewhat holding up. We may experience a mild recession for a brief while, maybe till fall or early holiday. But at least from 2024 spring onwards, we should start seeing growth. Now, why is that? Because I feel that, by then the recessionary impact will be gone. The Fed is already loosening the interest rate hikes slowly. So the market situation may turn from 24 onwards. So if that indeed happens, then for us, the factor for spring 24 in third quarter of FY24. So we should start seeing an uptick in third quarter from an order book perspective in preparation for spring 24. Also remember that, for spring 23, their purchases were muted and all of that. So there will be a base effect also. So I feel that overall, there will be a growth opportunity given that the consumption is expected to come back in 24. So this is one narrative. The second one, of course, is that the broader picture in the minds of retailers in the US and for that matter even in Europe is that the trend of moving away from China to other geographies is very strongly intact. They might have hit a slight pause button simply because at the moment they may not have too much of orders to move around, but the secular trend of moving out of China and moving into other geographies is very strong. And what I understand from many of them is that the costs in Vietnam have become prohibitively high and increasingly buyers are looking at other options and in particular India. So India seems to be a good rising star in their estimation from a future production angle. So that movement will get accelerated going forward when the volumes increase. So I see that adding to the tailwind going forward.
Okay. Sir, can you elaborate more on this Vietnam factor, which cost, how competitive we are compared to Vietnam?
So Vietnam, while people say the average labor cost is around $300 per month, vis-a-vis say in India of about $170, $180. In India, that too in the most expensive parts of India. I think, from what I understand is that the Vietnamese cost, even at 300, they may find it a bit difficult to get employees. They're finding that the other sectors are growing well. That's the economy which is heating up and the prices are going up further. So, margins for Vietnamese players will come under pressure with rising wages. So that's the wage arbitrage that we have between Vietnam and India. Okay.
And I think you have given some guidance for next year. I missed that because of some phone disconnectivity. So if you can repeat, sir, margin and revenue guidance for next year if you have given.
No, I have not given any particular guidance. We hope to hold the margins as far as possible at current levels. That is the intent going forward. As far as the revenue is concerned, what I indicated was that sequentially we will start growing, in the next financial year.
Okay. And sir, my last question is, having this new capex and new factories coming up, over next 2-3 years, what size of business we can do given an order and capability?
So we have we've already we have gotten one factory ready, which is in Bhopal, and we have the ability to start a second unit there. In addition, we have earmarked a plan to grow one more unit in the south. So all of these options we have in hand, and we will start work on some of these soon. The reason I'm saying that is any new factory will take about a year to fructify, at least a year, if not, in my estimation, it will be about 5 quarters before, we can start ramping up those capacities. And my belief is that this will, given that the market is expected to come back up in the later half of next year, we should start pushing forward on the capexes, as the capex also has a timeline to materialize.
So what size of opportunity you will be able to cater maybe over next 2-3 years? Any your objective or target, which I think you were given some years back also?
So based on the capexes that we have planned, we are anticipating that we can deliver about 1,400 crores of revenue in the 3-year or 4-year scenario, at least.
From new capacities?
From new capacities, correct.
Correct. Great, sir. Thanks a lot. Thank you very much.
Thank you.
Thank you. We have the next question from the line of Neeraj Mansinka from White Pine Investment Management Private Limited. Please go ahead.
So is it audible clearly?
Yes, you're audible.
Yeah. 2-3 questions. One, what is the capacity of the company in terms of the machines that you're having right now, sewing machines?
So based on the sewing machines, you're talking of a number of machines, or you're saying
yes.
Capacity in revenue terms?
No, number of machines.
Number of machines, we may have about 13,000 to 13,500 machines.
Okay, because it is 14,400 3 quarters back. So have you seen some?
That it is at those levels. I mean, you're talking of 1,000 only, right?
Yeah. And what is the number of employees that we are holding today? Employing?
At the moment, we are shared under 30K.
Okay, but this is also gone down from 32K. So have you seen a trend of reduction in employees and machines?
Only because we have let the natural attrition play out, given the correction in the revenue, right? So we have allowed some bit of natural attrition to happen. We have not backfilled them. As soon as we start growth again, we will start building up power.
Okay. And of the total ongoing capexes that we have, one we have all of the Tamil Nadu unit, which is in 2 phases, right? And one is of the knitting capacity. Is there anything else which is ongoing?
No. So there is a Tamil Nadu unit, which is a knit fabric processing unit, and there is one which is almost complete, which is the Madhya Pradesh sewing capacity or the garment manufacturing capacity. These are the two which are actively progressing and will fructify in FY24. In addition, we have one more unit in Bhopal, which we can bring up at short notice because a lot of the groundwork for that has also been completed. And we can bring up, two more units, one, of course, in South India, and we are also keeping the Bangladesh option on standby, which we were holding given the demand scenario. We may start working on that also at the earliest once we start getting a clarity on the demand.
Right. So, sir, we will be using our cash flows to repay the debt, entire debt, and use those cash flows to keep on growing with new capacity. Is this the right way to do it?
Can you repeat that question again? I'm sorry.
So we will use our cash flows to grow and keep on adding capex as and when required.
That is correct. That is correct.
Okay. And so 2 more related questions. One on how are you getting ready for the UK FTA? And do you see a large opportunity there?
Yes. So the way I see it, UK FTA is slightly on a slower track because of the change in government in UK and all that. We were earlier anticipating, when Boris Johnson was there to get complete, this to fructify by December. Then it got deferred to March. But I don't know. It may take another 3 months before it can fructify. But we are gearing ourselves up for it. We have already in the process of inducting one UK-based client, a new customer. We are talking to one of our customers also to see if we can ramp up. In the meanwhile, I see that the UK opportunity will help the UK-based brands from two standpoints. One, they will get a diversity.
तुम्ही ज्या व्यक्तीशी बोलत आहात त्याने तुमच्या कॉलला होल्डवर ठेवला आहे. कृपया लाईनवरच राहा. The person you are speaking with has put your call on hold. Please stay on the line. आप जिस व्यक्ति से बात कर रहे हैं उसने आपकी कॉल को होल्ड पर रखा.
Hello.
Hello.
Yes, I'm saying that UK brands have two opportunities available. One is one is diversify away from Bangladesh. India and Bangladesh will have a identically low duty structure. So Bangladesh exports about $3.5 billion to UK. So a portion of that can become available to India simply because the lead times from Bangladesh are higher. Fabric goes from India to Bangladesh and it the garments to UK. So India can offer a superior lead time while getting the similar cost structure. Second is China, which exports about $4 billion to UK. Opportunity, we will be about 10 or 12% cheaper than China. So some amount of those orders will also come to India. So I expect that Indian apparel industry will benefit at least by $1 billion incremental once the UK FTA comes. Now, different operators will get a different piece of it, but that's the trajectory I'm looking at.
Okay, I think this will be which type of general garments, like?
Say that again.
Which type of garments generally are imported from Bangladesh to UK?
So Bangladesh does a lot of, men's shirts, bottoms, all kinds of garments. Those, some of those garments will also come to India, right?
Okay. So last question, you said Vietnam opportunity is opening for India. What I understand is Vietnam is more on non-cotton side. And do you see India getting those non-cotton opportunities? Because what I knew was India was not so attractive destination from non-cotton side.
You're right. Vietnam does not only do non-cotton. Vietnam also does cotton. It gets cotton from other places and do it.
Yeah.
But the non-cotton opportunity will be harder. But we ourselves are doing a lot of non-cotton where we are competing with Vietnam-based players. So we buy fabric from China, Taiwan, Korea, and all of that. So as the labor cost goes up, the labor arbitrage increases. So, to the extent that it can even offset the transportation costs from East Asia of fabric into India.
So just on this related question only, do you see India has become very attractive to outsource for non-cotton fast fashion women wear or fast fashion products?
Fast fashion will be difficult because of lead time related issues.
So Turkey will still dominate that area. Is that right?
China, Vietnam could dominate until and unless some synthetic fabric ecosystem develops closer to India.
Right.
But it all depends on the cost structures, right? At some cost levels, things may have to give way.
Yeah. Okay. Got it. Thank you very much.
Thank you. The next question is from the line of Nirav Savai from Abacus Asset Management Company. Please go ahead.
Thanks for the opportunity, sir. I actually missed your initial remarks. I just wanted to understand about this employee expenses this quarter. Sequentially, there's a dip of around 10 crores. So what has changed on that side?
So there are two things. One is, of course, we let some bit of natural attrition play, aligning it to the order volume that we had. So if you have seen sequentially, there's a bit of a volume revenue drop as well. Right? Now, having said that, even as a percentage of revenue, we have improved. Our employee costs have gone down, and the reason for that is because we have worked hard on productivity improvement. That is what you're seeing there.
Okay, so this kind of a number is sustainable, or would it go higher on the fourth quarter?
Productivity improvement related is sustainable.
And this MP phase 1 would be what capacity? And you said about 50 crores of revenue, which will be there in FY24 is only from phase 1, right? 55 to 60 crores.
Exactly. But 50 to 60 crores will be in FY24. But as it fully ramps up, we will have 175 crores worth of revenue coming from that unit.
So you're saying only from phase 1. And what will be the optimal if we see second phase or even third phase?
second phase will be of an identical size.
Okay. So roughly about 400 crores or 370 odd crores we can get from this MP facility.
350 odd crores, right? 175 times 2.
Yeah, so that we can get from this MP facility, and we see that happening in FY25 or maybe later than that.
So correct. So the phase 2 will construction will start somewhere in the next financial year. So FY25, correct.
Right. Got it, sir. That's it from us. Thank you.
Thank you.
Thank you. The next question is from the line of Ashish Ubganlawar from InvestQ Investment Advisors Private Limited. Please go ahead.
Yeah, thank you for the opportunity. Sir, wanted to understand, I heard your initial comments on how you see things panning out over the next 4 quarters. So you said it would be probably flattish, maybe a couple of quarters on the revenue side, and then it would pick up in the second half of 24, I guess. So given the numbers that we have, I think we were closer to 600 crores in Q4 and Q1 of next year. So the base is relatively higher. So does it mean that we will be flat on those numbers, or you think that it will be lower than those numbers then on the sales side?
No, so while a lot depends on how the market turns, my assessment is that we should eventually work towards getting there or better, right?
Yeah. Okay. But the visibility that you have right now, there should not be a problem kind of meeting those last year numbers on the sales, right? Is that
so as I said, sequentially we will start climbing back, and the assumption we are making is that by early 24, the markets in the States and for that matter Europe should start picking up and doing better. And if that indeed happens, then we should have no problem in doing it.
Okay. But given your dialogues with your customers and reading of the entire situation, very hazy kind of outlook on how things are going to pan out, or
the haziness is for near term. So when I look at sometimes something like spring 24, I don't think general consensus is that it should be strong across a large number of industry observers, people who are in the business in retail in the US. So that's the those are people who have been in the industry for years. So that's the expectation from such guys. But in the short term, the economic indicators are all over the map. So there are some indicators which are favorable, some indicators which are not so favorable. So people are becoming a bit risk averse. But if, let us say, the recessionary trends are not protracted, then we may start seeing even a earlier uptick.
So in your business, from a retailer's perspective, the inventory kind of drawdown, is that what has been playing over past maybe couple of quarters, and does it work that way, in bringing down the inventory in these times and then probably take a call?
Yeah, so they tend to bring down the inventory. So they are sitting with a little higher inventory because they went into an overbought situation last year.
Yeah.
So they're working their inventory out as we speak, and many brands are at different stages of working that inventory out. So some of them will work their inventory out in a quarter or two at most, and then they will realign and start buying.
Okay. And finally, one more thing. From your balance sheet that you've reported right now, I don't see any issue on the working capital or receivables as such. But anything on the recoveries, any stress there, or is it all normal?
None whatsoever. We are closely tracking all of our customers. And none of our customers seem to have we closely track their financials and all of that. We don't anticipate any problem whatsoever there.
Okay. Thank you so much, sir. Yeah.
Thanks.
Thank you. The next question is from the line of Anush Kumar from Spark Asia Impact Managers Private Limited. Please go ahead.
Good afternoon, sir. Congratulations on a decent set of numbers on a difficult environment. My first question is a data keeping question. Basically, if you could give the capex breakdown for FY23 among the existing facilities and Krishnagiri, Bhopal, and Perundurai would be helpful.
We have for the year FY23 about 84 crores is being spent in Perundurai unit. Another 32 crores, whatever we have highlighted, that is for Bhopal project. Krishnagiri project has been implemented last year itself, and that is completed last year.
Okay, sir. So and the sustainability of the margin, considering the fact that the productivity is improved, can we expect about 25 to 30 bips improvement in the margin for FY24?
Over the current levels, you are saying?
Yeah, over the current levels.
No, I don't think so, because FY24 will have all kinds of headwinds and challenges in the early phase, and there will be price pressure. So you might have seen that our gross margin slightly dropped in Q3, but we more than offset it by productivity improvement in the quarter. So there will be those kind of headwinds which may have a countervailing effect. So an improvement in margin of 3 or 4% above current levels probably is not sustainable, right?
Yeah. Fine. Okay, sir. Thank you. Thank you so much.
Our overall effort will always be to continue to improve productivity and thereby work on margin improvement. But to deliver a 3% improvement in 1 year is not possible. We'll try our best to see how much of productivity gains that we can drive through.
Okay, sir. So actually, my question was, I was asking about 30 bips. It's not 3%. So it was 11.9% for Q3. So anywhere between 12.2, 12.3.
Yeah, that is possible. 30 basis points and all. Yeah.
Yeah. Okay.
Question. Sorry.
Thank you, sir. Thank you.
You're welcome.
Thank you. The next question is from the line of Atul Mehra from Motilal Oswal Asset Management. Please go ahead.
Yeah. Hi, good evening, and thanks for the opportunity. Congratulations on a good set of results. So just a couple of questions. One is that next financial year, FY24, what is the revenue that we can do at, assuming that we can achieve the highest capacity utilization?
Okay. So that's a theoretical question because, we need orders to deliver those revenues, right? So
Correct. Theoretically, yes.
In the first quarter of this year, we did a revenue of about 600 odd crores. So with our capacity, with our machine capacity, we should be able to do that kind of a revenue if theoretically that those were the orders that are available today without those incremental capacities coming on stream like Bhopal, etc. Having said that, the manpower capacity has been realigned to current revenue levels. And we will, if the revenue picks up, we will realign the manpower to those levels.
Right. So, sir, so 2,400 crores of the current capacity, and what you were mentioning is the new facility that will come on stream. In year one, we can do about 60 crores of revenues or something, correct?
That is correct. By the time we hit year two, it will be 175 crores.
Right. Got it. And sir, secondly, like one of the things about the slowdown and demand slowdown and so on and so forth, like what I understand is like it is more to do with broader environment, and if we are able to plan capacities better in terms of overbooking and so on, like we can basically make sure that we try and achieve our capacity to the fullest extent. So given that we have some time on our side for 24, would it be like reasonable to assume that like we will be trying our best to utilize that 2,500 crore threshold despite the macro environment? Because while the macro environment is there, but for our size of the company, the construct of the size of the market, it is not that big a constraint. So
very
maybe
good
some comments. Yes, sir.
Very good question. What happens is that, if you look at the global markets, right, the top three markets are US, Europe, and China. And all the three of them put together have 43% of global market share. Okay, so the garments sold in these three regions are 43% of world consumption. And all of these three markets are at the moment underperforming for various reasons, right? US on a kind of a little bit of an overbought situation, excess inventory, and a mild recession expected. Europe because of the war, but that also now, seems to get baked into their equation, and, we may start seeing growth going forward. And China because of the COVID-related slowdown in buying from end consumers. So what has happened is that there is a global demand-supply mismatch, which is what has currently resulted in the order book slowdown. Now, theoretically, if we start pumping for incremental growth, one has to now start offering cut rate and, bring down the rates and all of that. We have historically been extraordinarily reluctant to compromise margins and give an illusion of lower price, etc., to win the business, because that would compromise us over the longer term. People will start resetting their price points with us to a lower level, which we are, totally reluctant on. So I can compromise margins to drive revenue growth, but we have so far held back on that count.
Got it.
That's why we are more profit driven than simply top line driven.
Makes sense. And so one final question in terms of with all the expansions that we have under plan. You mentioned earlier 1,400 crores is the incremental revenue. So if you were to combine everything, all combined, then as of now, the capacities that we are having under plan can do a theoretical revenue of about 4,000 crores over the next 2 to 3 years' time.
2,400 plus 1,400, right? 38.
Yeah, 3,800 crores. Got it. And this is by FY25 end.
This would be by FY26.
By FY26. Got it. And then one other thing, I think you also, as part of your commentary or in answer to some of the questions, said that we are also opportunistically looking at any brownfield assets, or like would this be in the form of any M&A or any asset purchase that you have in mind, or it is more to do with the existing capacity in brownfield?
No. So existing capacity brownfield is anyway there, but
Yes.
if there are opportunities, we are not averse to it. So we, as and when an opportunity comes to the table, we don't mind looking at those as well.
From an M&A perspective.
That's right.
Right. All right, sir. Thank you very much, and wish you all the best.
Thank you.
Thank you. The next question is from the line of Arvind Kothari from Niveshaay. Please go ahead.
Thanks for the opportunity and an excellent performance given the situation, sir. I had a question that from the standpoint of the UK $1 billion opportunity that you said could open up, how are we planning? What portion of that pie you think we'll be able to cater, and going forward maybe the whole Eurozone might get opened up for our country. So what share of our total revenue do we plan to have Eurozone going forward?
So Eurozone plus UK put together currently contributes to 4% of our revenue. Historically, we have operated, when I say historically, even 5 years back, we were at about 20%. So our ability to ratchet up European share exists. That will not come at the cost of US. It will be an incremental growth. So we are open to doing more business as long as they are margin accretive and all of that. At the moment, since FTA with UK is being planned, we have opened up more dialogues with UK-based customers, and I have identified opportunities to expand in early FY24 with UK-based customers. So those discussions are going on, specific styles, etc. So we will be ramping up UK-based revenue to start with. As and when European FTA is signed, then we will go all out after Europe. At the moment, we are going slow with Europe.
Okay. And so the next part of the question is that, the ramp up that happened, in China was basically, they having more of a OPEX kind of a model where CAPEX was almost funded by the government, where the land was basically provided by the government, and hence the scale up happened very fast. So the tailwinds that our country has, maybe in terms of the, labor wages, do you think the CAPEX bottleneck can maybe have the growth to be slow, or how do you see that part?
Okay. So it really depends on the company rather than industry as a whole, right? So people like us, we are not capex shy, and if we see an opportunity, we will go with capex. That is point number one, and we have the cash flows and the cash holding to go for capex. Second is that there are certain states in north of India, MP being a case in point, which are actively encouraging us with a lot of incentives, which will allow us to recover our capex investments also at the earliest. So net, while capex funding like China may not be possible, but the macroeconomic conditions now that exist in India is also moving in that direction. So it's a little more favorable to setting up capexes these days in northern geography. That's the reason why we chose Madhya Pradesh to expand.
Got it. Perfect. Thank you so much, sir.
You're welcome.
Thank you. The next question is from the line of Danesh Mistry from Investor First Advisors. Please go ahead.
Hello.
We can hear you.
Yes. Hi. Good afternoon, sir, and thank you for taking the time out. I just had two questions. One, I think you alluded to the fact that gross margins have been lower this quarter. I think roughly by about 400 bits. So is that a function of our product mix? We are making more, I would reckon, t-shirts versus jackets. That's question number one. And question number two is that, sir, regarding your other expenses this quarter, it's come down year over year by quite a bit, from about 45 crores to about 36 crores. So is this number sustainable, and what would be the components in it that have actually reduced? Is it shipping, transport, or something else? And do you see this kind of number sustaining going forward, sir? Thank you very much.
Let me answer the first part on gross margin. Let me answer the first part on gross margin.
Yes, please.
The gross margin reduction is on account of two things. One is, of course, the product mix in the third quarter changing from outerwear to fashion wear, because in third quarter we produce more of spring wear, and the garments are largely cotton and cotton viscose based. So the margins are slightly lower there historically. But in this particular scenario, because in the third quarter we also had a fairly heavy headwinds on order placements, etc., we also saw that the brands were willing to place orders only at on a tighter margin. So while we let the margins slide a bit, making sure that we can overcome with better productivity, we did not allow it to slide even more. So we stopped there. So part of the gross margin reduction is on account of product mix. Part of it is because of the market conditions.
Understood.
As far as the other expenses are concerned, Satya, you may.
Other expenses, it is primarily on account of the supply chain related costs, air freight costs, which we had last year, almost close to around 7 crores. That was the one, it's a one-off item, which we ensured that this quarter it is not there, and that is the reason. And this is sustainable, more sustainable going forward also.
Got it, sir. And sir, if I may just squeeze in one more question. So going forward, I heard you on the call saying that, essentially because we are working on season, we essentially would not be too impacted by the inventory destocking at the customer's end. So is it correct to assume that going forward, at least whatever headwinds were there, especially on volume, are now past, whilst margins would take time to catch up?
So my expectation is that the volume impact has more or less is bottoming out and will start improving. Margins, all my opinion, will be bottoming out in this quarter or next quarter, and then hopefully our productivity gains will be here to stay. So we should start as the volumes return back, that is the business volumes return back. Some of the productivity improvements that we have put in place will be there to stay, and hopefully we should be able to improve our gross margins as well.
Got it, sir. So in that case, then the employee costs may not come back in the same fashion as the volumes would.
Correct.
Got it, sir. Okay. Thank you very much, sir, and wish you the very best of luck. Thank you.
Thank you. The next question is from the line of Pulkit Singhal from Dalmus Capital Management. Please go ahead.
Thank you for the opportunity and congrats on a good set of numbers, tough environment.
Thank you.
First question is just to understand the inventory correction bit. My understanding is that it has been going on for last 9 months odd, the destocking. So when you look at your top 4-5 customers, which are a larger chunk of your revenues, roughly what number of days of inventory was it sitting at, say, 9 months ago versus now?
So many of them were sitting on 3 months of excess inventory. So if they were sitting on 3 months inventory, they were sitting on 6 months inventory in the past. I think now they would have, reduced half of that excess inventory or more, depending on the brand.
Understood. Okay. So, because my understanding, so therefore, I would think from their perspective, I mean, the demand that you generate for your products, the worst is behind from that aspect, right? I mean, incrementally, the whole China plus one.
That is correct. That is correct. But so far, the retail market has not slowed down much in the States. If that slows down, then, the inventory, while they have reduced it, that inventory may bloat a bit. Though I'm not so sure that will happen because so far the US market still has been resilient.
Understood. But we also, one more thing was that during these last 9 months was China was closed. So I don't know whether it was an easier period for us to gain orders, whether there was a supply issue from Chinese suppliers and how does that impact going ahead?
Conception, last 9 months, China was closed from a market standpoint. So people were not buying garments. However, the Chinese suppliers were all functioning. So Chinese capacities were fairly intact. So what we had was the Chinese capacity also coming and fighting in the global market. So a lot of Chinese capacity is directed towards China as a market. So we've had situations in the recent past where Chinese capacity were also trying to, which were domestic capacity, were fighting in the international market. We may see some of that, going away and going forward because the Chinese markets are now opening up.
Okay, so it's a good thing for you in that way. Okay.
That is correct.
Okay, and from a pricing aspect, like-to-like pricing, because our RM prices are also corrected, and therefore asset turns assumptions would change. What would be the like-to-like pricing decline you would think, for a product which is sold in Q1 FY23 versus what you might sell next year? That one should assume.
It's a very, very difficult question to answer because, let's say Q1 to next Q1, I would say the orders are still coming up. But let's assume that if I look at it from last Q1 to the current Q1, right, the Q1 FY24, yeah. I would think that, the raw material prices have come down. Raw material prices have come down by about 6 or 7%. And our realization or, the price realization also has come down by about a similar margin. Usually, we should have price realization come down to lesser than the raw material price decrease. But it has been a little more than that this time, given the softness of market. We hope that we will be able to recover that incremental going forward.
Understood. And the full benefit of China plus one would play out more in a scenario when once the end market starts growing and you see higher share of incremental orders and not necessarily on the existing revenue trajectory.
That is correct.
Okay, understood. Great. Thank you and all the best.
You're welcome.
Thank you. The next question is from the line of Surya Narayan from Sunidhi Securities. Please go ahead.
Am I audible, sir?
Yes, you are, sir.
Congratulations, sir. Thank you for giving me opportunity. Just to understand from the working of the operational point of view, the job work charges have been substantially declined by around 1% if you see 9 months to year ending, and so is the 3.5% so far as the working employee charges. Just to understand whether how much out of the 30,000 employees we have casual laborers and the regular employees, if you can give bifurcation, and why the job work charges have declined significant. That is the first part. Thank you. I'll come next.
100% of the employees are on roll. There are no, no temp labor that we hire for compliance-related reasons. The job work charges are when we have very specialized tasks for which we may not have the capacity, we give out and get it manufactured. Second is sometimes when there are very tight deadlines, etc., then we may outsource or something like that for completion. But at the moment, as we have improved productivity and capacity utilizations, etc., we are trying to reduce the job work charges. It has always been our endeavor, and we have been able to control it quite a bit.
Okay. And sir, another critical question just now, if you can give answer. Out of 520 crores of revenue, just to, if you can give a figure, then how much of, let's say, potential orders we might have rejected due to our non-acceptance?
How much of orders we would have rejected due to what?
Due to our, critical benchmark of, margin and all.
Oh, there is, it's a little hypothetical because, we just don't bid on those projects. So if I want to drop margins, I can get any amount of orders. So it's a bit of a hypothetical question. We don't pick those orders. So, it's not like I reject it. When the customer solicit orders, we'll only bid at those which we feel, we can make the money.
Okay. And what is about the status about our operations or our plan towards the going to Bangladesh partner because we are not discussing anymore. So are we dropping that?
Bangladesh is very much in the play.
Sorry.
The asset has been identified also. I have deliberately slowed down the start of the work on that asset primarily because of the current market conditions. We are actively considering whether we should now quickly, start working on commissioning the works on that project, as there will be a lead time to construction as well, and that can time well with the markets turning. So that is where we are. So Bangladesh is very much in the play from a observation perspective.
And so last year in the fourth quarter we saw some hike in the employee cost. So will there be repeated this year for the older plants? I mean, I'm not including the MP plant. I believe that in MP the employees will be on the learning curve phase, and definitely the productivity will definitely drop there. Am I right, sir?
So employee costs in MP as a percentage will be higher in the initial period because the productivity will be lower. As far as year on year is concerned, there will be wage hikes, etc. So there will be wage cost increases in line with minimum wages going up and the DA, which is inflation linked, going up. So wages do go up, and we will have to absorb those wage increase. So there will always be a pressure on wage going up, and that will have to be offset by productivity.
So all those things, the wage hike will happen in fourth quarter?
So we have the DA hike going up in the first quarter of next year. We have already had a wage hike in the fourth quarter this year. So those are all being factored in.
Okay. Thank you, sir. Thank you.
Thank you. The next question is from the line of Jagdish Sharma S., an individual investor. Please go ahead.
Good afternoon, sir. Congratulations on a great set of numbers. Just want to know your perspective on our exposure to the Turkey country. Like, as a country has went through the natural disaster and crisis, what are our exposure to Turkey, and how are we gonna overcome that?
Our exposure to Turkey is zero. We don't supply anything to Turkey. In fact, Turkish manufacturers supply to Europe. The US market. So on their customer side also, we don't compete much. So from an opportunity perspective also, I don't see much happening unless those guys come specifically for certain specific technical capability we have. But exposure to Turkey, zero.
Okay, can I ask you some questions which is not related to it? Like, what are our Indian markets exposure to Turkey? In that way, can you explain it, please?
What are Indian markets exposure to Turkey?
Yeah, like anything we are exporting from Turkey and something like that. Can you?
Of course, there will be spinners who are sending yarn to Turkey. There will be people who are sending fabric to Turkey. We are only in the garment manufacturing phase, which is what happens in Turkey. So there will be definitely other people may have exposure to Turkey, which which you have to go after the individual players.
Okay, sir. So also, when will our debt be will come down? So from it will be in a breakout like zero. Will it come to zero or something like that level?
Our debt?
Yes, sir.
Our debt is at near zero levels only.
Okay. So I'm asking also any guidance can you give for the next quarter and?
We request you to rejoin the question queue if you have further questions.
Okay. Thank you, sir. Thank you for taking my question.
Thank you. The next question is from the line of Sunil Kothari from Unique Asset Management. Please go ahead.
Just one question to understand. You have moved from Karnataka to Tamil Nadu, which is having a very good supply chain and ecosystem for garment manufacturing. But Bhopal and MP is a new. So what is your experience? Which are the challenges you face, and what is your thought process for a future garment industry expansion for Gokek's point of view and at large also?
So from our standpoint, we have to expand in places which are low cost in the long run. And from that perspective, we have identified Madhya Pradesh as a place to grow, and we have also identified other places in India which are sustainable in the long run. The wage cost in the south eventually will grow, and so will the availability of employees. While the condition in certain other regions of India may be more favorable. That's why we intend creating incremental capacities in those regions. My early experience in Madhya Pradesh, like we've just started hiring trainees for training purposes, have given me the confidence that there is enough labor available, and they have started joining. The training absenteeisms are very low. The enthusiasm to work is very high because there is not enough of competing jobs available to them. So I think some of our assumptions are playing out as expected. So if further we are convinced that we are getting a good employee flow, then we should expand more and more in Madhya Pradesh and such regions in the north of India.
Okay. But you feel the ecosystem for in terms of say transportation, supply chain?
No, that is not a problem at all. Fabric and all is available in the north. There are several mills like Arvind in Gujarat, Vardhaman in Madhya Pradesh itself, and so on and so forth. So mills are available from a fabric standpoint. Access to ports from Bangalore to Bombay or Madhya Pradesh to Bombay are all more or less equivalent. Labor availability is good, so we don't see much of a problem from any of these perspectives.
Great, sir. Thanks a lot. Wish you good luck.
Thank you.
Thank you. The next question is from the line of Abhineet Anand from Emkay Global Financial Services. Please go ahead.
Yeah, just on the tax rate, seems to be, every quarter has been quite different. So for 23 and 24, what could be the number one should be looking at?
Mainly on account of recognizing the liabilities which are available for you to claim the deduction at a later point of time, and so you recognize the deferred tax asset during this year. So this year, our average effective tax rate, you can assume between 17.75 to 18%. Going forward, effective rate of 25.17 will play out, and we should be seeing a number around 23% is what is our estimation at this point of time.
Thank you. The next question is from the line of Anush Kumar from Spark Asia Impact Managers Private Limited. Please go ahead.
Sir, what sort of currency assumptions have you taken for FY23, and in case if you have hedged, and what is the average rate at which you have done that?
So we book forward cover to the extent of about 60% of our revenues for the year ahead, and we have a formula for rolling 4 quarters. So that's how we have done, and we normally book the currency at the based on forward covers. We would have the dollars sold at a marginal premium over the current rates. So then that's the forward premium, and we also tend to book our orders based on those rates.
Thank you.
Yes. Thank you, sir. Thank you.
Ladies and gentlemen, that was the last question for today. I now hand the conference over to the management for closing comments. Over to you, sir.
Thank you so much for all your questions. As a company, we continue